The Bedrock of Stability, a comprehensive guide to the Vanguard Value ETF, ticker VTV. As of March 13, 2026, the global investment landscape is witnessing one of the most significant structural shifts in a generation. After years of growth at any cost dominance driven by silicon and software, the market has pivoted aggressively toward the value renaissance. Investors are seeking refuge in companies with tangible assets, robust cash flows, and sustainable dividends. The Vanguard Value ETF, ticker VTV, has emerged as the definitive vehicle for this transition. Earlier this week, on March 11th, the fund closed at $199.39, though it has seen some healthy consolidation toward the $197 level in the last 48 hours. Currently trading near its all-time highs, VTV represents a bet on the real economy, the banks, hospitals, and energy giants that underpin global infrastructure. This deep dive explores the value rotation of 2026, the specific titans that power this $173 billion portfolio, and the strategic reasons why VTV is becoming a core holding for both retail savers and institutional giants. 1. The business case, the 2026 value rotation. For the better part of the last decade, value was the laggard of the investing world. However, the narrative has flipped in 2026. The end of the growth monopoly. The accelerated momentum we see today is partly driven by a cooling of the AI infrastructure frenzy that peaked in late 2025. As investors began questioning the sky-high valuations of tech firms that lacked immediate profitability, a great rotation began. Money has flowed out of high-multiple growth stocks and into large-cap value. Macro environment. With central banks transitioning from a rapid easing cycle to a simultaneous hold at relatively high interest rates, the present value of future earnings for growth stocks have dropped. The renaissance. In contrast, value stocks, which focus on money being made today, have seen their valuations re-rated. As of early 2026, value-themed global equity funds are outperforming growth benchmarks by a significant margin. 2. Inside the fund, the giants of the real economy. VTV tracks the CRSP U.S. Large Cap Value Index, providing exposure to roughly 312 to 326 of the largest value stocks in the United States. Unlike specialized sector funds, VTV is a diversified powerhouse. 1. Financials, approximately 22.1% of the fund. The financial sector is the largest engine in VTV. Led by J.P. Morgan Chase and Berkshire Hathaway, this segment is currently thriving. In a 2026 environment where interest rates remain sticky and above pre-COVID levels, large banks are enjoying expanded net interest margins. Berkshire Hathaway, a top 3 holding, provides a unique layer of safety through its massive insurance float and diversified industrial subsidiaries. 2. Healthcare, approximately 14.3% of the fund. This segment offers a defensive cushion. Holdings like United Health Group and Johnson & Johnson are non-cyclical. Their services are required regardless of whether the economy is in a boom or a bust. In early 2026, these firms are benefiting from an aging global population and a wave of new medical technologies that have finally cleared regulatory hurdles. 3. Industrials and energy, approximately 23.9% combined. The energy hedge. With crude oil prices fluctuating near $75 to $80 per barrel due to geopolitical tensions, top holdings like ExxonMobil act as a natural hedge. The infrastructure play. Industrial giants like Caterpillar are the primary beneficiaries of the U.S. infrastructure buildout, which is entering a peak construction phase in mid-2026. 3. Fees and fundamentals, the 0.03% advantage. In the world of 2026, where every basis point counts, VTV's most potent weapon is its cost, the ultra-low expense ratio. VTV carries an expense ratio of 0.03%. To put this in perspective, for every $100,000 you invest, Vanguard only takes $30 per year to manage the fund. Many active value funds charge upwards of 0.75% to 1.00%, meaning you would pay $750 to $1,000 for a similar basket of stocks. Valuation check. As of March 2026, VTV is trading at a forward PE ratio of approximately 21.2x. While this may sound high for value, it is a significant discount compared to the broader S&P 500 or the Nasdaq, which often trade between 28x and 35x. You're effectively buying high-quality, cash-generating businesses at a 30 to 40% discount to their growth-focused peers. 4. Performance and dividends, the stability machine. VTV is designed for total return, the combination of stock price appreciation and cold, hard cash in the form of dividends. The 2026 scorecard as of March 13, 2026. Market price, approximately $197. 52-week range, $150.43 to $208.20. Year-to-date return, approximately 4.96% to 5.2%. While the tech-heavy indexes have struggled with a flat start to the year, VTV has consistently trended upward. Dividend yield. The fund offers a trailing dividend yield of roughly 1.95% to 2%. Dividends are paid quarterly, and the next ex-dividend date is expected on March 27, 2026, with a projected payout of approximately $1.01 per share. The dividend growth story. Over the past decade, VTV has increased its dividend at a compound annual growth rate of over 5.5%, which means for a long-term investor, the yield on cost continues to rise every year, turning VTV into a powerful income generator for retirement. 5. Critical risks. What to monitor this week. Even a fortress fund like VTV has specific vulnerabilities that you must evaluate before starting an investment. Interest rate sensitivity. While banks in VTV benefit from higher rates, bond proxies like utilities and consumer staples can suffer. If the Federal Reserve surprises the market with a rate hike in mid-2026 to combat sticky inflation, these specific sectors within VTV could see a short-term pullback. Concentration in traditional growth. Some stocks inside VTV, like Walmart and United Health, have performed so well that they are beginning to trade at growth-like multiples. There is a risk that if the value moniker is applied too broadly, the fund could face a correction if these specific, high-quality value stocks experience a valuation reset. The laggard trap. In a true risk-on environment, e.g. if there is a massive breakthrough in fusion energy or a new tech cycle, VTV will almost certainly underperform. You are trading explosive upside for downside protection. 6. Strategy. How to position VTV today. In mid-March 2026, the smart money is treating VTV as a core portfolio anchor. The buy-the-dip entry. VTV recently pulled back from its 52-week high of $208.20 to the current $197 level. Technical analysis see this as a healthy rest within a larger uptrend. The support level, strong support, is currently established at $194. For a new investor, starting a position near $197 and adding more if it touches $194 is a logically sound staggered entry. The diversification play. Many 2026 investors pair VTV with a small allocation to growth, VUG, or emerging markets, EEM. However, for those nearing retirement, a 70% VTV, 30% bond split is once again becoming the gold standard for capital preservation. Conclusion. The Vanguard Value ETF in 2026 is a story of sanity returning to the market. It is a fund that rejects the hype of speculative technology in favor of the companies that keep the lights on, the stores stocked, and the banks solvent. With a record low 0.03% fee, a $173 billion asset base, and a portfolio dominated by the most profitable giants in history, it is the most efficient way to bet on the long-term resilience of the American economy. The verdict. You aren't buying VTV to double your money in a month. You are buying it to ensure that your capital grows steadily, yields a growing stream of income, and remains protected when the more speculative corners of the market inevitably face a correction. In 2026, value isn't just a stock.